Hi, I'm Bill Kaufman with Remote Trading Room. And today, well, it's April 20th, 2024. And we're going to talk about the 10-year U.S. Treasury Note. But first, a quick note from the legal department. Remember, this is for educational purposes only. It's not a recommendation to buy or sell anything. It's just to make you a better trader. All right, back to the U.S. Treasury Note, the 10-year. This is the benchmark for just about all the rates that are out there. The federal funds rate, the savings rate, any kind of interest rate, credit card rates, a mortgage rate. You can see that this is a pretty important. It's the most widely traded bond, which the note is a type of bond, in the world. Okay, so let's go to the chart and take a look at the U.S. Treasury Note, the 10-year.
All right, well, here's the 10-year Treasury Note chart. Now, before I get too far into it, just a little history for you. Up till about the late 90s, the U.S. serviced its debt with the 30-year bond. But when we had a couple of years of budget surplus back 98, 99, the Clinton administration thought it'd be prudent to change the debt servicing to the 10-year U.S. Treasury note. And that's what happened. And so that's why this is so important, the 10-year Treasury note. As I mentioned earlier, the rate that the 10-year Treasury note is at happens to affect mortgage rates and so much in the economy. Okay, let's go ahead and look at the chart. This is the 20-year chart where each one of these are called candlesticks, represent 1 month going back to April of 2004 to April of 2024. And this chart is the price of the 10-year note. And this price is inversely related to the actual interest rate. So the higher the price, the lower the interest rate. Sky high price, very low interest rate. Low prices, and you get higher interest rates. And like right here, if we go back to, this is around the financial crisis, 2007, 8, 9. Interest rates were cut a lot. And so the price of the note went up. Came back down and then back up. And if we fast forward here to about 2020, look at COVID. You can see the COVID in a very short time. They cut interest rates to about 0.5%. So the prices shot up and stayed up there. And there was a lot of government spending, a lot of money out there. And so the government said, hey, maybe we need to raise rates to stop inflation. So they raised rates quickly, and so the prices just dramatically fell. And the note, the 10-year was all the way down here, this 109. And they said, well, maybe we ought to, have to raise rates. Cut rates. And of course, the note went up some, and they went, okay, yeah, we're going to raise. And they did. They raised it, 4 or 5%, and note price dropped down a lot. And then around November of 2023, they said, hey, we're going to probably do 7 rate cuts in 2024. The market said, okay, then we're going to go ahead and raise the price of the 10-year note. And they raised the note, but rates didn't really come down. And so, since the rates stayed high, the prices of the note came down. And this is where they thought they were going to have 7 cuts. And then in February, they thought, well, we're only going to do 3 cuts. And they announced that momentary spike in the price of the note. And then they came out in April and said, probably no rate cuts. So price went down. And if you look where we are today, in April 2024. We're not too far off from these lows back August 2007. And when you get to below this mark here, about the 103, the price of a note, then there's just no telling what rates could do. Probably stay slightly above 5%. Now I have two lines here. The blue line is the 200-day moving average. The white line is the 50-day moving average. And you can see since just after the financial crisis, they were 50-day was well above the 200 until we get around here. And this is where they've said, okay, the rates are going to be staying up to stop inflation. And the 50-day just dropped way below the 200. And when they cross like that, where the 50-day goes below the 200, that's called a death cross. And so you just got to look out below here. If this keeps going down as far as price, that means rates will stay high, possibly go higher. And that could be, well, money gets expensive, makes everything, mortgage rates, everything is tied to the 10-year Treasury note and the rate. Because remember, the 10-year Treasury note is the most widely traded bond, and the note is a type of bond in the world. Okay, I hope you enjoyed this little overview of the 10-year Treasury note. I'm Bill Kaufman with Remote Trading Room, LLC. And remember, this is for educational purposes only. I hope you enjoyed it. I hope to see you again. Thank you.